Hello everyone, my name is Simon. I'm from Finance Engineering Australia. We are specialists in financing your growth and engineering your wealth. Recently I've been bombarded with a lot of queries about how do I buy my first house, or more specifically people's been asking me how do I buy my house if I don't have enough deposit. So what I've noticed is that around of my clients and friends, they commonly have between 5 to 10% of deposit when they want to buy their first house. However, the bank will generally lend you 80% if you don't want to pay what we call a lender mortgage insurance. So a lot of my clients and friends, they get stuck on this question. They say, I don't really know if I want to pay lender's mortgage insurance, so maybe I should just wait. And they'll wait to save more, and so they have 20% deposit. Now I'm going to explain to you what this all means in real numbers and a scenario that I can give you, and you'll see why I strongly advise you not to wait if you can afford to buy a property. And I'm not an advocate for property investing, and I certainly can't tell you how the market will move, but if you look into historical data, there's some science behind it. So let's look at the scenario here. We got a property at $400,000, assuming you are buying to live in yourself. Generally, the bank will need you to have 20% deposit, so $80,000 if you don't want to pay lender's mortgage insurance, and the bank will lend you the rest, which in this case is $320,000. Now, a lot of people that's buying their first house, they probably be on an income of around $60,000. So that will give them a net income monthly about $3,980. So to say this is $4,000. And most people, when they are trying to save more money, and they will probably cut back their expenses, don't go out as much, don't drink as much, whatever. But their basic living expenses like rent, telephone bills, utilities that you got to pay, you're still going to be looking at around $2,000 per month as expense. So that means you effectively saving $2,000 of your income every month. So for you to save the $80,000, you are going to need 40 months to save. Okay? So 40 months is about 3 years. So after 3 years, with 3.5% growth, that property is now going to be $445,000. Now you put this equation back in here, you need more deposit, and the money that you require from the bank is a little bit higher, which means you need to have more income. And we all know that, as a matter of fact, in Australia, our income doesn't really grow as fast as the property market. So it's an endless game of trying to chase, and some people get lucky, they get a good pay rise, they can afford, they can now buy their dream home, but some people don't, and they're just forever chasing that deposit. So I'm going to show you a better way. It will cost you a little bit more, but it's a much better way of getting a property. So if we look at the same property for $400,000 and we go to the bank for you at 95%, the bank is going to give you $380,000. Now that $380,000, obviously you need to pay LMI on top, so the lender's mortgage insurance. Now a lot of people ask me, what is lender's mortgage insurance? Does it protect me? No, it doesn't. It doesn't protect you, it actually protects the lender. So it's the money that you pay to insure your lender that if you become in default or in arrears, the bank will actually get paid. And what happens is then the insurance company will then come after you for payment, and then they will sell your house if you can't make the payment. So the insurance is not there to protect you. There's something else that protects you, but we won't discuss here. We can discuss in another video in the future. But basically, you will need to pay between $12,000 to $15,000 for that house, for this property that you're currently buying. However, the good news is that the bank will actually give you that money to borrow. So they will lend you $395,000. So now what you need to come up with is really $20,000. And you have that already. So if you have that already, you can get this house, and when you buy it, it's going to be $400,000. Now after a year, 3.5% growth, which by the way is fairly low. I believe if you spoke with property agents, they'll probably tell you it's between 5% to 6%. But I'm going to be conservative here because I don't want to be overly optimistic. So it's going to be about $414,000 after the first year. Now this is a break point for you because your property has increased value by $14,000, and that $14,000 you've secured, which will pay your lender's mortgage insurance. Okay, so that's really important to keep in mind, because the second year, the third year, now you're just gaining more equity on this property, and you don't have to worry about having not enough money to save for your first property. You can move into your property right now and enjoy the benefit of owning your own home and having the property grow. Whereas if you're just renting and trying to save, I can tell you, in Brisbane, in Sydney, in Melbourne, there's very likely to be an endless game of chasing and chasing and chasing, and you're probably never going to get there. So the idea here is, don't think about the cost it's going to get you into a property, but think about the cost that is not going to get you into a property. So the opportunity cost is here is that for you not to be paying that lender's mortgage insurance, you are missing out on the capital growth of the Australian market, and you are paying more rent. Alright, so that's it for today. If you want to see more videos like this, please subscribe. We'll be uploading more videos in the future explaining to you different strategies and methods of investing and financing. And we specialize in financing your growth and engineering your wealth. So we are Finance Engineering Australia. My name is Simon. Thank you very much.